Good evening. Welcome to the new edition of Mutual Fund Talk from ETF Junction. As you all know, ETF Junction is a fintech platform which intends to provide a complete ecosystem for ETF industry, which involve all the stakeholder of that, which is manufacturers, ETF service providers, stockbroker, finfluencers, advisors, and above all, the ultimate user, which is the investor. The endeavor at our end is to solve the underlying challenges with the industries confronting with, which is the awareness and lack of proper infrastructure, and create a platform for very smooth and inclusive growth of ETF in the country. That's an endeavor which we have been taking up for last roughly around 1.5 years. In recent years, we have seen the entire passive industry shaping up pretty well. If you look at the total number of roughly 57 lakh crore mutual fund industry, ETF is roughly the entire passive is 9.48 lakh crore. And that clearly shows that, people's understanding about passive is adding up because of the, clear-cut fact that cost effectiveness, transparency, potential for diversified exposure and all that, right? Now, when we look at this trend has been clearly very strongly getting pronounced as we progress. Today, I think we will be exploring the multi-factor ETF, a notable player as far as in the entire passive investment sphere goes globally. Just to give you a sense that, if you look at the total global ETF industry, roughly 80% is conventional ETF, 20% happens to be your smart beta when we come to India. And in that 20% smart beta, roughly 50% is multi-factor. So that is where we are. Very happy that, we have someone, who is an expert. And I must say that, someone who has been really, taking the mantle of, spreading awareness about mutual fund and has been coming up with extremely good funds is Mr. Umesh Dalia from Mirae Mutual Fund. Without further ado, let me introduce our expert for the subject who will be discussing on this entire topic of multi-factor ETF today. So Mr. Umesh has more than 18 years of experience in the sales and distribution channel management, business acquisition for mutual fund industry in both retail as well as banking business. Currently, he heads the national ETF sales channel. It's got a flair for looking forward to the new areas. Has done extremely good for enhancing business volume and growth. He's worked with various mutual fund earlier. The fact that he has been with Mirae earlier, he has worked with Tata AMC, IDBI Bank, and he's a commerce graduate and holds an MBA degree in finance and marketing. So very briefly, to just give you a brief background, on the discussion which we are having today. Clearly, smart beta fund is something which is really getting attention. And if you look at the fact that passive clearly has its own huge advantage, so I'd not like to repeat and reiterate, but the fact that, large cap funds, largely if we look at, or even the other, funds which we are looking at, clearly non-performance vis-a-vis the benchmark is one reason, followed by lack of, clear-cut differentiation. Even in the large cap, the themes which could, really make a difference is like momentum or XYZ. I think that is something which is luring people. And third, clearly the cost effectiveness. So it's something, smart beta is something where, people are really looking forward to get a huge advantage with its cost effectiveness if they can get added value of alpha. Today, we have Mr. Umesh Dalia to talk about this. Umesh, the first question to you, right? Can you just, for the larger investors who are quite early in their investing career, can explain the smart beta or the factor fund, right? And how is it different from the traditional market cap weighted funds? Umesh.
Yeah, first of all, thanks, Saket and ETF Junction for having me on this show. So actually, the smart beta or a factor investing is something which is coming out, very clearly, or maybe it's becoming flavor of the market. Investors are choosing these kind of products, especially very interestingly, traditional investors as well as the new age investors, the DIY investors. Everybody is is attracted toward these kind of products. So before that, let me make you understand what the smart beta factor fund or a factor fund is. So basically, traditionally, we have been investing in a scenario where fund manager creates a portfolio, and on that portfolio we invest, and then fund manager keep on changing the portfolio as per the objective of the fund, and sometimes on the opportunities available in the market, and accordingly the portfolio can be made and can be churned. So what happens in that case? Obviously, the when fund manager choose a fund, obviously they look at some kind of parameters also for a stocks. selection process I'm talking about. So that selection process always go with momentum, quality, value, all different kind of parameters that fund manager generally uses while selecting a stock. So that's the same rule. It has been there in the same kind of structure is already there in the investment cycle on a active side. Now the passive smart beta is basically nothing but actually to to replicate or to replicate those strategies on a passive platform which is under a rule based platform. So what happens, like, the smart beta is nothing but it gives you an flavor of active management as well as the passive management. So it is basically, it gives you activeness within passive. Why? Because the portfolios are being churned on the basis of factors. Factors can be different in keeping the market cycles. Where if you compare it with the traditional way of investing, where plain vanilla indices are there, where the stocks are being selected on the basis of market cap. Here in this case, that is not the scenario, because from a plain vanilla index, we try and put different filters. As I said, keeping the market cycles in mind, we know the market have different cycles. So accordingly, there are factors. So those factors keep in mind, the portfolios are being created, and then accordingly the index is being created, and the ETF or product or passive funds are being launched. So it is one, I must say, a one step further from a normal plain vanilla where indexing, and this is something which is now in flavor, not in India, maybe across the globe.
Thank you so much. Clearly, this is some innovation from the indexing. Clearly, it's got the best of both worlds. If you look at active and passive, or something where people can look forward to getting advantage of investing in passive with activeness in it. Thank you. Now, coming to the next question, clearly, as you look at the flavor is now moving on from one factor to multi. I think we have seen a couple of funds where three factors are there. Generally, two factors are being combined. So how does the multi-factor approach of any ETF benefit investors compared to a single factor ETF?
Yeah, I think as I told you at the start of it, basically it is a one step further from a normal investing behavior, and I told you that market has different cycles. So we know market has bull market, bear market, sideways market, volatile markets, and all that. So accordingly, there is a factor which plays out well during that particular market cycle. So when you invest into a particular fund, keeping in mind that okay, in a particular index, and you keep in mind that markets are on the bull side, and we want to capture the bull side of that market only, and we want to capture or select stocks on the basis of that factor, which is beneficial or getting good results while the time of bull market. That is called a factor, single factor investing. But as I said, when you invest, we always look for a longer time period, longer horizon. We have been telling investors all the time that there should be 5 year plus kind of horizon investors should always keep in mind while investing. So in those scenarios, there are different cycles where market generally goes through. So multi-factor is what? Multi-factor is basically nothing but combining two different factors, in most of the cases two opposite factors, which generally captures both the sides of the market. Like, to give an example, just to explain this further. Say if we combine a factor of, say, there is a momentum factor, there is a quality factor. If we combine both of them, so momentum factor works very well when markets are on bull phase. Quality factor works well when markets are on a bear phase, because the companies on a quality factor are being captured or selected on the basis of return on equities, debt to equity ratio, and EPS variability. So all these put together makes a quality portfolio. So when market goes down, and maybe on a correction side, the drawdowns in your portfolio you will see will be protected at somewhere, because the companies in that are a quality company. Similarly, on a momentum side, where we always look at companies who has done well in last 6 months and 12 months on the base of risk adjusted returns, those companies are also selecting those companies can always help you in terms of enhancing the returns when the market on a bull cycle. So idea is to combine two factors, or maybe this is one example, that there can be multiple factor, alpha low vol, there can be maybe growth related also. So the combination can be any, but these are the combination which actually helps when the investor actually looking for a long-term investment horizon and don't want to care about market cycles. They just want to stay invested and want to get a decent kind of returns. I must say this is a structure which helps in investors to go through different market cycles and look for a long-term investment horizons.
Thanks. Clearly, it has got an advantage where they both factors complement each other, and we have been seeing different ETFs which has been coming like momentum with low vol, and as you rightly said, a momentum with uh, you know uh, quality, and there could be so many combinations. So this is where the entire product is evolving. Maybe more factors added. So thank you so much for that clarity to the investors. The next, clearly, if you look at the investors, they have a portfolio. They already be having active funds, right? Mutual funds. The key question, and if you look at the entire industry of ETF, it changed after 2015 when the PF Provident Funds were approved and all. Now the key point here is that what sort of investor should look forward to this particular product, right? Whom it is more suitable for, and what are the due diligence or the research one need to do before getting into this product, Umesh?
See, the way market has cycles, similarly, the factors also are having cycles. So, the cyclicity is something which is really important while entering into any kind of investment, especially in factor side. As I said, there are factors which will work in a different specific market cycle. So, investors should be aware that every factor has a cyclicity. And when we approach this factor investing, there can be two ways you can approach. One is on the short term or a tactical call. Another is a long term call where your horizon is 5 year plus. From a tactical call perspective, investors should be very much aware about the cyclicity. Investors should be very much aware about the risk associated with it. Investors should be very much aware about the market volatility and the behavior of that particular factor. So if that is taken care, investor is aware, I think that investor can take a short-term call also. But any investor who's new for the market and want to participate in say specific cycle of the market, then I would say the multi-factor is a good strategy to go with. And for a longer period horizon, I think these kind of factors generally we have seen from a past experience give you a better returns when as compared to a multi in most of the cases as compared to a single factor. But it is not right to say that a multi-factor is better than a single factor, or a single factor is better than a multi-factor. Both have their positives and negatives. So sometimes single will do well, sometimes multi-factor will do well. So investors should always keep in mind which sort of factors they are investing into.
Thanks for clarifying that it's not that multi has an edge over single factor. Clearly, either of them have their own strength and weakness and can play out in any portfolio. Now, the key point, see, they have been investing. I think if you look at the Indian investor who started investing since 1964, right, from the US 64 days, they have seen a very good flavor of the active funds. Now, when they're looking to this fund, are there any historical performances or evidence which supports, that these funds or these factors has led to the outperformance or creation of an alpha, right? So would you like to just share if there is any relevance or if there is any indicative, information pertaining to that?
Yeah, I mean, so I'll just answer this question with one example, because let's put two factors here will be easy to understand. So when I say, I'll just take my last example. When I say two factors which are say complementary to each other, like say quality and momentum. So the index seem to be focusing on generating alpha by using momentum factor, and along with that, trying to provide the stability also to the portfolio during the turbulent time in the market, which is by using the quality portfolio. So now the quality and momentum, these two are the complementary to each other. The data shows that Nifty mid small cap 400, momentum quality 100 index. Why I'm talking about 400? Because one is mid and small category is unique, and the 400, when we talk about something, the market which can give you a better alpha, and from a volatility point of view, it will be little on the higher side. So what point I'm trying to make here is that data shows that Nifty mid small cap 400 momentum quality 100 index is delivering better returns in the long run. Along with the returns, the market risk, which is the volatility, is also lesser as compared to the plain vanilla indices. So which may appeal investors who are seeking for a single solution to mid cap and solution in investing. So it compares the performance of index versus actively managed mid cap fund also. Now, if I talk about data as on 30th April 2024, I'm talking about direct plan. So this has outperformed on a 10-year basis all the mid-cap funds. All the mid-cap funds have been underperforming this index. I'm talking about mid-small cap 400 momentum quality 100 index. All the mid-cap funds has been underperforming this index for last 10 years as on 30th April. And the and also the actively managed funds has generated a return of around 21.5% last 10 years, whereas this index has given 24.5%. Right. So this is an index which has outperformed the parent, even the parent Nifty mid small cap 400 index. This has outperformed 13 out of 18 calendar years. So this is what I'm trying to tell you is that putting a better complement factors to each other, sometimes we can see these kind of returns or these kind of results are also being said. So this is one example. We can see similar kind of example in different multi-factors also.
Thank you. That's a very good example, I would say, and that clearly has a good track record, a period covered, and also I think the indices. So thanks for giving a fair bit of clarity on that. Coming next, I think you've just come with a new fund, right? The new fund offering, which is Mirae Nifty Mid Small 400 Momentum Quality 100 ETF, right? So could you like to just throw some light, what is this product all about, and how should an investor look forward to this, and how does it differ from the other products in the category?
So basically, see, when I talk about mutual fund industry in India, it has evolved in last decade, it might say, and it has. So with that evolvement, we see a lot of active funds are there. A lot of AMCs have started their operations. There are a lot of new licenses are there. Unique offerings are coming up. But when I talk about mid and small cap as a category, that is certainly missed out because and that's a very important category because when we do a individual asset allocation or individual allocation from a market cap perspective for any investor, we always try to give some flavor of mid and small cap. Since the category is not available, generally investor or advisors or investor himself or herself go for some kind of mid cap and a small cap because at the time of categorization there is no such category evolved or you can say issue or maybe advised by the regulator. So that's why this category doesn't even exist. So there is no such product which gives you flavor of mid and small cap, both the sides, right? So right now we can say on active side, there's hardly any chance that anybody can launch as we speak right now. And then, but at the same time, the passive side gives us that freedom where we can launch any product provided there is an index and that index is replicable. So the data is available and we can create an index that is replicable product can be launched. And that is why we thought of coming out with strategy or with a segment or a allocation pattern from a market cap perspective, which is not available. And that is where the discussion or the emergence of this mid and small cap category came into our mind. And we have the idea is to capture those 400 stocks, 150 mid cap and 250 small cap, and want to judge or want to select stocks on the basis of. So we have put two main factors here, which is one is momentum, another is quality. But before that, what we did, we just wanted to remove or eliminate the risk of liquidity because when we talk about mid small cap, there can be scope for a liquidity say assessment or liquidity challenge. So we wanted to so first we eliminate few stocks on the basis of liquidity. When I say liquidity, when in terms of say in terms of their listing history, in terms of their promoters say pledging status, in terms of what sort of circuits that particular stock is hitting, in terms of the bottom 10 stocks on the basis of average daily trading value. So on these parameters, we eliminated few stocks and then we put a quality filter and a momentum filter. And on the basis of quality and momentum, we selected 100 stocks, which will be divided between mid and small cap. So there will be 50 small cap stocks and 50 mid cap stocks. From a market cap perspective, obviously mid cap has higher market cap. So the market cap weightage will be 70% mid cap and 30% small cap. So idea is to provide something to the investor which investor can have a exposure in one go into this particular segment with a 70-30 ratio and with a predefined rule-based investing where quality and momentum factors are being put in, so that on the both sides of the cycle, these portfolio can come out as stronger from your portfolio perspective.
Thank you. Just to understand, Umesh, why have you selected these two factors only? There were factors like dividend yield, factors like liquidity, factors like volatility. When you've selected these two factors, right, which is quality and momentum, any rationale for that?
See, when I talk about Mirae Asset Nifty mid small cap 400 momentum quality 100 ETF, so that at least the name is little large. So
Yeah.
it considers the entire mid and small cap universe of 400 stocks, and then by applying liquidity, quality, and momentum criteria, it selects, as I said, 50 mid, 50 small cap. So the index is why we selected this. As I said, this is a complement portfolio. The both the factors are basically complementary to each other. One captures the upside, one captures the downside, and from that perspective, we thought this is a very good portfolio from where we are capturing two major cycles of the market, the bull cycle or the bear cycle. The idea of to create something where these two cycles can give max benefit to the investor. So there are multiple factors. As I said, value is also one factor that generally works on a recovery phase. But we found this data coming out more stronger than the normal some other factors. And since it's a very, as I said, this category is itself was not available. So first time we're launching this category, and these two factors are more you can say prominent factors from that perspective. And on the basis of results and on the basis of quality of stocks which we selected, we like this concept and we launched this because this is, as I said, this is the most talked asset allocation within any investor's portfolio. So we thought of providing it with these factors.
Perfectly. It's clearly a new offering in its kind or in its segment, and it clearly looks like the investor will look forward to and will lap it up in a big way. Coming to the last question, this multi-factor has really been building up. As I said that globally, if you talk about in smart beta, 50% allocation goes there because it's a good cohesion of the complementary factors being put together. What do you see? Where do you see the growth of multi-factor products in India? And how does it get into the investor's portfolio? When I say how does it means, what are the distribution channel you are using at this point in time? For better clarity.
Yeah, see, first of all, though, I just want to start this answer with one thought of mine, where there's a lot of discussion that active versus passive. You're trying to tell that active will not do well or passive. There's always return comparison. But I must say, when I talk about smart beta, it is beyond active versus passive because this is something which gives you something which you might not get on an active platform. So it helps investors in terms of completing their portfolio, in terms of filling the gap which are there in the client's portfolio. Because here in the active side, lack of differentiation within active funds, underperformance of large cap funds, and the cost-effective alternatives, we believe that it has already have led to a structural change for smart beta investing landscape in India. As on 30th April 2024, there are already 27 smart beta ETF which are managing close to 5,295 crore of assets, and there are around 30 index funds managing around total assets of around 14,800 crore. So you can see in last 2 years there have been 32 new products launches within passive smart beta category. So you can see how the interest is climbing and how the investors are really keen to understand and to invest into that. See, once the investor is showing some interest, we as a manufacturer, our endeavor is to provide more unique products to the investor, keeping their keeping the underlying stocks or what sort of asset allocation we should make in, and then investor can take his or her call in terms of keeping his or her risk appetite in market, so in their mind. So we believe in last 1 year also, if you look at from a data perspective, the passive smart beta funds have seen an inflow of around 8,400 crore plus in different categories. Obviously, it is led by momentum and equal weighing and some into quality, but you can see slowly and gradually different other factors are also getting some kind of traction. So Previously, we have seen this smart beta category was only restricted towards large cap and mid cap. Now we launching this mid and small cap product. We already have launched one product on small cap also. So now the smart beta is going down and moving towards small cap universe also, where you can create more innovative products, keeping the plain vanilla index on as a universe. So that kind of trajectory that India is witnessing is very similar to the developed markets. Like if you take an example of USA, and experts believe that the smart beta investing would become central to India's asset management industry in near future. So what, because as I said, investors are changing, their behavior are changing, their understanding, their requirement are also changing. So in this scenario, I think these kind of products are really important from a manufacturer perspective also, and from an investor perspective also. I personally believe that this is a space which is going to be pretty large in India in coming times.
That's a wonderful start is put in by you. Roughly 5,000 crore of roughly ETF smart beta and 14,000 crores of passive. Really roughly 19,000 crore. And if we look at the industry of 7.9.45 is the passive. And if you take ETF, we are hardly less than 5%. But the way beginning has happened and the kind of strength the product has, clearly it's got a great future. And as you rightly said, it's not between active, passive, but this is something is missing in the portfolio and it will really enable us. So thank you so much for being with us for this particular session of mutual fund talk, and really was beneficial and fruitful for all our investors. And thank you so much. Thanks a lot.
Thank you, Saket. Thank you, ETF Junction, for having me. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.